of all business activity is dependent upon two major factors. One is the cost and the other one is the sales. As such, it is important to analyze both the variances on cost as well as the variances on sales. Cost variance is the difference between what should have been the cost, popularly termed as standard cost, and what has been the cost, that is the actual cost. If the actual costs are less than the standard cost, the variance is termed as favorable, that means positive. However, it may so happen that the actual cost may be more than the standard cost. And when the actual costs are more than the standard cost, the variance is termed as the adverse or unfavorable or negative. Sales variance is the difference between what should have been the sales, popularly termed as the budgeted sales, and what have been the sales, that means the actual sales. If the actual sales is more than the budgeted sales in a particular period, the variance is termed as adverse or unfavorable. Thus, in totality, the variance may be classified into two categories. One is the cost variance and the other one is the sales variance. In the following sections, we will have a detailed discussion on both the types of variances, that is cost variance as well as the sales variance. Cost variance can be put in the following flowchart. It is of two types. Costs, as you know, that the costs are of majorly, the main components of the costs are of three categories. One is the direct material, another one is the direct labor, and the fourth one is the overhead cost. Accordingly, the cost variances have been categorized into three categories. Direct material cost variance, which is in short called DMCV. The second one is the direct labor cost variance, in short it is called DLCV. And the third one is the overhead cost variance, OCV. Direct expense constitute, it is also a component of the cost, but it constitutes an insignificant portion of the total cost of the product. Hence, direct expense variance is generally not calculated. Suppose it is desired to calculate direct expense variance. In that case, it can be computed in the same manner as the variable overhead variance is being calculated, since in most cases, direct expenses are variable in nature. So instead of computing the direct expenses variance, we need to compute the overhead cost variance, which is called overhead, means the indirect cost. Indirect cost variance is being calculated instead of computing the direct expense cost variance. At this point, however, we suggest that you should have a look on the exhibit 11.1 given towards the end of the unit, which presents a detailed discussion on the variance and the interrelationship of variance, which will be clear from the illustrations given. Whenever you are in doubt, a reference may be given to that exhibit so that your doubt can be clarified. In the course of discussion in this unit, you will find the abbreviations, the major abbreviations which are frequently used in this session. They are given as under. The different major abbreviations used in this topic are DMCV, that means direct material cost variance. The second one is DMPV, direct material price variance. The third one is DLCV, direct labor cost variance. Next one is DLRV, direct labor rate variance. Then DLEV, direct labor efficiency variance. Then variance OCV, that means overhead cost variance. Then VOCV, variable overhead cost variance. Then FOCV, fixed overhead cost variance. Then FOEXPV, fixed overhead expenditure variance. Then FOVV, fixed overhead volume variance. Then SVV, sales value variance. Then SPV, sales price variance. then SPOLV, sales volume variance. These are the major components used in this. The next is from the direct cost variance, the first component is direct material variance because the material component is the major component in the cost. Three types of direct materials are explained here. The first one is the direct material cost variance, DMCV, which is equal to the difference between the standard cost of different materials specified for the output achieved and the actual cost of direct materials used. The standard cost of materials is computed by multiplying the standard price with the standard quantity for actual output, and the actual cost is computed by multiplying the actual price with the actual quantity. Thus, the formula for computation of direct material cost variance DMCV is equal to total standard cost of direct materials minus total actual cost of direct materials. Standard cost of direct materials minus actual cost of direct materials. The standard cost of direct materials can be determined by standard price into standard quantity for actual output, and the total actual cost of direct materials can be determined by actual price into actual quantity. So if the actual cost is more than the standard cost, it will result in an adverse variance and vice versa. Let us take an example so that it will be very clear. Suppose the standard output is 800 units, actual output is 1000 units, standard quantity per unit is 1 kg, total actual quantity used is 1200 kg. Standard rate per unit is 4 kg and actual rate per unit is 5 kg. So in this juncture, if we calculate the direct material cost variance, the equation would be standard cost for actual output minus actual cost. It would be 1000 into 1. 1000 is the actual output and 1 is the standard quantity per unit, and it has to be multiplied with 4 minus 1200, that is the total actual quantity used, into 5. 5 means the actual rate per unit. So it comes to 4000 minus 6000. 1000 into 1 into 4, it comes to 4000, and 1200 into 5 is 6000. So the difference is 2000 negative. That means the direct material cost variance is 2000 adverse. Next is, if the standard output and the actual output are different, as in this case, the variances are to be calculated keeping in view the actual output. The information regarding standard output, which is different from standard quantity, is thus not relevant. The material cost variance may arise either on account of change in price, quantity, or it may be due to the both. The reason may be either due to the change in price or the change in quantity. Thus, material cost variance may be further analyzed as material price variance and material usage variance. So direct material cost variance, as discussed earlier, DMCV, can be categorized into two segments, that is direct material price variance or direct material usage variance, DMPV or DMUV. Direct material price variance is concerned with that portion of the direct material cost variance which is due to the difference between the standard price specified and the actual price paid. Formula for computation of direct material price variance is equal to total quantity into standard price minus actual price. Standard price and actual price, the difference of standard price and actual price has to be multiplied with the actual quantity to find out the direct material price variance, that is DMPV. If the actual price is more than the standard price, the variance would be adverse, and in case the standard price is more than the actual price, it would be in a favorable position, that is called the variance would be favorable. The material price variance based on the figures given in the example will be computed as under. DMPV, that means direct material price variance, would be, that is 1200 into 4 minus 5. That means standard price is 4 and actual price is 5. So the difference in price is 1. When it is multiplied with 1200, the actual quantity, that would be 1200 adverse. The reason for price variance may be as under. There are the first reason is fluctuations in market price. If for a particular product the market price is fluctuating, then it may lead to direct materials price variance. The second reason is market trends may bullish or bearish. That means in case of capital market, if there is sizable fall or rise in the pricing of the product, then it will result to the direct material price variance. The third reason is increase or decrease in prices on account of agreement between various suppliers or on account of government intervention. If the government intervenes, suppose it is the product is of necessity in nature, and due to intervention of the government, there is a fluctuation in the price, that will also result into the direct material price variance. The next reason is buying efficiency or inefficiency. If the buying efficiency or inefficiency of the customers either increases or decreases, it will have an impact on the direct material price variance. The next reason is high or low cost of transportation and carriage of goods. When there is variation in the transportation cost of the goods carriage inward, that will also result into direct material price variance. Changes in or laxity in pursuing purchase policy. If the purchase policy is suffering from any laxity on account of persuasion, that will also result into the direct material price variance. The next reason is superior or inferior, non-standard or substandard material might have been purchased. When there is purchase of substandard or low standard materials, it may result into direct material price variance. The next reason is purchases might have been effected in small quantity instead in bulk or vice versa. That means if you are purchasing in piecemeal instead of going for bulk purchase, the result will definitely have an adverse impact on the pricing of the product, and this will affect adversely the direct material price variance. Substitute and the cheaper materials might have been used. When we put to use the low grade quality of product as our materials, that means in order to reduce the cost, when such type of practices is being adopted, it will definitely result into direct material price variance. The next reason is emergency purchase. Placing rush orders for immediate delivery at the prevalent price, that would also result into direct material price variance. The next one is fraud in purchase of loss of discounts. Fraud in purchase means when there is manipulation in purchase and there is loss on account of giving discount, that will also result into the direct material price variance. The next reason is incorrect setting of standards. When the standards are set by the organization is incorrect, is not based on facts and figures, that will also result into direct material price variance. Some of the facts may be controlled by the management if care or proper control is exercised, while others may be beyond the control of the management. Out of the regions given here, some of the regions are within the control of the management and some are beyond the control of the management. If the factors are controllable, the buying department is usually answerable for unfavorable variance on unfavorable region of direct material price variance. Then after direct material price variance, we will go to the direct material usage or quantity variance. The change or the variance is there due to two reasons. One is the price, another is the quantity. So after price variance, we will go to the quantity variance. Direct material usage variance is that portion of direct material cost variance which is due to the difference between the standard quantity specified for the output achieved and the actual quantity used. The equation or the formula for computation of the direct material usage variance is equal to standard quantity for actual output minus the actual quantity into the standard rate. The actual quantity, if more than the standard quantity, it would result into unfavorable variance or vice versa. The usage variance will be computed as follows based on the figures given in the above example. Direct material usage variance is equal to 4 into 1000 minus 1200. Here, the 1000 is equal to the actual output and the 1200 is equal to total actual quantity used. 4 is the standard rate per unit. So when the standard rate is multiplied with the difference in quantity, that would be 400, and that 400 would be adverse. The total material price and the quantity variance is equal to material cost variance. That means the difference between the two would be equal to the direct material price variance because they are the resultant of the two. Direct material cost variance is equal to direct material price variance plus direct materials usage variance. When we have computed the direct material price variance, it was 2000 adverse, and here the direct material price variance is 1200 adverse, and here the direct material usage variance is 800 adverse. When both are combined together, 1200 and 800, that comes to the same 2000, and that is also adverse in nature. So the reason for direct materials usage variance may be as under. There are different reasons for direct materials usage variance on account of quantity. The first one is inefficiency or lack of skill or faulty workmanship resulting in more consumption of raw materials. When this workmanship is defective, that means low skill or the poor quality of laborers or workers are being engaged. This resulted into consumption of more raw materials, and that definitely resulted into causing inefficiency, and that may be due to the adverse material usage variance. The second reason may be lack of proper upkeep and maintenance of plant and equipment and a frequent breakdown during production process leading to wastage of materials. So obviously when the plant and machinery is frequently comes under breakdown, the production will definitely be hampered, and when the production is hampered, there will be definitely wastage of materials. So this would result into variation in direct material use that will definitely cause the direct material usage variance. This next reason is non-consideration of product design and method of processing, etc., while fixing standards. So when the fixed standard is being fixed, if we do not consider the product design and method of processing, that would definitely result into the direct material usage variance. The next is incorrect processing of material resulting in wastage. When the wastage materials are not properly processed, then it would give rise to the waste. When the materials are not properly processed, it will definitely give to wastage, and more wastage would directly adversely affect, or it will have a direct impact on the unfavorable situation of direct materials usage variance. The non-recording of returns of materials of stock or stores or inter-transfer from one job to another. When there are different units of production are there in a factory, and there is inter-unit transactions between one one department to the other and one unit to the other. The stock transfers, if there is refund, and the inter-transfers between one job and other are not properly recorded, that definitely resulted into the variance in uses, and that is another reason for this. Then improper inspection and supervision of workmen resulting in adverse quantity variance due to careless handling and processing. When there is a careless handling and processing, then there would be loss of quantities of raw materials put into production, and that would definitely resulted into the direct material uses variance. Then the next reason for direct material uses variance is too strict supervision or inspection resulting in excessive rejection of materials. When the management is so strict on the laborers, on the workers, then out of scarcity, out of scaredness, they may commit blunders, and this may result into excessive rejections of materials. So that is another reason of direct material uses variance. The next reason of material uses variance is substitution of specified materials with unspecified materials, causing greater consumption of the latter. You must be knowing there are two types of materials. One is specified materials and another is unspecified materials. When unspecified materials are consumed more and more than the specified materials, then it may result into direct material price variance, and the probability of the uses variance cannot be ruled out under the circumstances. The next reason is incorrect setting of standards leading to variation. When we are setting standards as against the actual production, the standard setting, if it is wrong, then it will definitely give rise to the variation in the direct material uses. Then the next one is excessive wastage, scrap, spoilage, shrinkage, leakage, etc., causing an adverse use, and that will result into direct material uses variance. So computation of various direct material variances, the illustration is from the following particulars. Let us find out the material cost variance, material usage variance, and material price variance. The quantity of material purchased is 4,000 units. The illustration says that the quantity of material purchased is 4,000 units. Value of materials purchased is 10,000 units. Rupees 10,000. Value of materials purchased is rupees 10,000. Standard quantity of materials per unit of finished product is 2 kgs. And standard rate of materials is rupees 2 per kg. Opening stock of materials is 1,000 kg. And closing stock of materials is 2,000 kg. Finished products during the period is 1,000 units, and standard quantity of materials required is 1,000 into 2. 2 is the rate, that is coming to 2,000. Standard quantity is materials per unit is 2 kg. Then for standard quantity of materials required would be 1,000 into 2, that would be 2,000 kg. Actual quantity of materials used is equal to material purchased plus opening stock minus closing stock, and the material purchased is here 4,000 units, and opening stock is 1,000 units, and the closing stock is 2,000 units. So 4,000 plus 1,000 minus 2,000, that is coming 3,000 kg. That is the actual quantity of materials used. Standard price is rupees 2 per unit, and the actual price is 10,000 divided by 4,000 units. 10,000 is the value of materials purchased and 4,000 is the quantity of materials purchased. So per unit, the actual price is 2 rupees 50 paisa per unit. So direct material cost variance would be the total standard cost minus the total actual cost. Total standard cost, that means the standard price into the standard quantity, and the total actual cost would be the actual price into the actual quantity. Standard price is rupees 2. And the standard quantity is 2,000 units, and the total actual cost, the actual price is the standard price into that is 2 into 1,000 minus 2 rupees 50 paisa. 2 rupees 50 paisa is coming as what? The standard price. So the standard price into 2,000 is the actual quantity. that comes to 4,000, and this is coming 2,000 minus 5,000. Since the minus symbol is there outside the bracket, it is coming minus 7,000. So 4,000 minus 7,000, that is coming 3,000 as adverse. So here the direct material cost variance giving a result of adverse figure of rupees 3,000. Here the presumption is done, the quantity we have consumed on the basis of FIFO method, first in first out method, and the result, the net result, it gives to be 3,000 adverse. When we are computing the direct material usage variance, that is on account of quantity, that is coming, the equation, the formula is standard price multiplied with the standard quantity minus actual quantity. So the standard price is 2 per unit, and the standard quantity is 2,000, and the actual quantity is 3,000. So it is coming 2,000 into minus 1,000, that is the standard price, and when that is multiplied with 2,000 is multiplied with minus 1,000, it gives an adverse result or a negative result of 2,000. So the direct material usage variance is adverse 2,000. Let us now calculate the direct material price variance, which is another component of the direct material cost variance, price and quantity. The quantity variance gives a result of 2,000 advance, and the price variance, when it is calculated, the actual quantity into standard price minus actual price. So 1,000 is the actual quantity, 2 minus 2, and plus 2,000 into 2 rupees minus 2 rupees 50 paisa. So the result is 1,000 adverse. So the direct material price variance is 1,000 adverse, and the direct material usage variance is 2,000 adverse. It will be observed that the total materials usage variance and total material price variance is equal to the material cost variance, that is 3,000. So the resultant of the direct material cost variance is equal to the direct material usage variance and the direct material price variance. Then after the material is over, the major component of the cost is labor, and that is direct labor. Direct labor, as you see, the labor which can be directly identified with the units produced, that is called the direct labor. The deviation in cost of direct labor may occur because of two main factors or two main reasons. One is the difference in actual rate and the standard rate of labor. That is the first reason. And the second reason is the variation in actual time taken by the workers and the standard item prescribed for performing a job or a particular operation. Labor variances are very much similar to material variances, and they can be very easily calculated by applying the same techniques as used in calculating the material variance. The readers can work out the various formula for direct labor variance by simply putting the word time in place of quantity in the formula meant for direct material variance. The various labor variances may be put as under. The first one is, it is the difference between the standard direct wages specified for the activity achieved and the actual direct wages paid for the particular purpose. The formula for computation is direct material cost variance is equal to standard cost of actual output minus actual cost. Standard cost of actual output minus actual cost. In other words, you can say direct labor cost variance is equal to standard rate into standard time for actual output minus the actual rate into actual time, that is actual cost. Actual cost, when it is deducted from the standard cost of actual output, that would give rise to the direct labor cost variance. From the following example, let us see how the direct labor cost variance has to be calculated. Standard output is 200 units. Standard time per unit is 2 hours. Standard rate per hour is rupees 3. Actual output is 160 units, and the total actual time taken is 300 hours. Actual rate per hour is rupees 350. In this juncture, when you are asked to compute the direct labor cost variance, the standard rate into standard time for actual output, that means rupees 3. Standard rate per hour is 3. and 160 is the actual output. So 3 into 160 into 2 minus 350 into 300. That is 2 is equal to the standard time per unit and 350 is equal to the actual rate per hour and 300 is the total actual time taken. So this gives rise to 960 minus 10550. That means 90 rupees adverse. So the direct labor cost variance as calculated here is 90 rupees adverse. The direct labor cost variance may arise on account of difference in either rate of wages or time. Either on account of rate of wages or the time taken for completion of the product. Thus, it may be further analyzed as rate variance or time or efficiency variance. So this has been given in the following chart. Direct labor cost variance, that means DLCV, direct labor cost variance is the component of, or it is divided or it is segregated into two types of variances. Direct labor rate variance DLRV and direct labor efficiency variance DLEV. Direct labor wage rate variance. Direct labor means direct wages. Direct wages rate variance. Direct wages efficiency variance. It is that portion of the direct labor which is due to the difference between the standard and the specified rate of pay and the actual rate paid for laborers for a particular job. Formula for computation of direct labor rate variance DLRV is equal to actual time into standard rate minus actual rate. So when actual time taken, it is when the same is multiplied with the standard rate minus actual rate, this will give rise to the direct labor rate variance. If the actual rate is higher than the standard rate, it shall result into an unfavorable variance, or vice versa. If the reverse is true, then it will be favorable position. So based on the figures given in the above illustration, let us calculate the direct labor rate variance. Here, the 300 hours, if you look to the actual time is 300 hours and the standard rate is rupees 3 and the actual rate is rupees 350. So the difference in the rate is coming to minus 50 paisa. When that is multiplied with 300 hours, that gives an adverse result of rupees 150. So the direct labor rate variance is coming to be 150, and that to adverse. The reason for direct labor variance is, the first one is it may be on account of deployment of more efficient and skilled workers, giving rise to higher payment. When we are engaging more efficient workers, obviously we need to make more payment of wages to them, and this may be one of the reasons for direct labor rate variance. Higher payment due to shortage of availability of labor. When there is constraint of labor in the factory, then obviously they will have to pay more to the laborers for completion of the work, and that may resulted into direct labor rate variance. The third reason is lesser payment due to abundant availability of labor or high competition among them for employment. If the flow of labor is more, then obviously the management would be in a position to make a bargain with them, and the labor force can be utilized with a lesser payment, and that would also result into the variation in the direct labor rate. The next reason is employment of unskilled laborers causing lower actual rate for pay. That means when you are engaging the workers who are not having any experience, then what will happen? We can engage them, or we can do our work with lesser payment, and that will also result into a variation in the direct labor rate. So the variance will be calculated accordingly. The next is extra shift allowance to workers or overtime allowance for work done after normal hours, leading to higher wages. Overtime normally it is paid at twice the normal rate. So when due to execution of the work on priority basis, if overtime is being offered to the workers, then obviously the labor cost would be more and more. And on that juncture, the direct labor rate variance would be definitely adverse. Then high pieces rate for better quality production. That means when we are doing our production on piece rate basis, and in order to produce quality product, when we are offering high piece rate, then what will happen? It will definitely cause or resulted into the direct labor rate variance. The next reason is change in the system of wage payment. That means from time wages to piece wages, or from piece wages to time wages. When there is a variation in the change in the system of wage payment, that will also resulted into the direct labor rate variance. The next reason is change in wage rates, probably due to revised agreement with the labor union. When the management entered into fresh agreement with the trade unions, then obviously there would be higher wage rate to be given, higher facilities to be provided to the workers and to the laborers, and that is the reason why there would be a variation in the direct labor rate. The last reason is higher rate during seasonal or emergency operations. So when there is a constraint in the hands of the management that the desired amount of output has to be produced on a deadline basis within a specified period, then obviously we need to gear up the labor force, and for that we may pay the high rate to the workers, and that may be another reason of causing direct labor rate variance. So these are the reasons for variation in the direct labor rate. Then after direct labor rate, the next one is the direct labor efficiency variance, which is another cause of direct labor cost variance. There are two components: direct labor cost variance and direct labor rate variance. So after direct labor rate variance, let us come to discuss about direct labor efficiency variance. It is the portion of the direct labor variance which is due to the difference between the standard labor hours specified for the activity achieved and the actual activity. Actual time spent for the labor. So formula for computation of the direct labor efficiency variance is labor efficiency variance is equal to standard rate into standard time minus actual time for actual output. So based on the figures given in the same illustration, the labor efficiency variance will be computed as follows. Labor efficiency variance is equal to the standard rate, which is 3, given in the earlier illustration, that is 3, and the standard time is 320 hours, and the actual time for actual output is 300 hours. So this is coming 20 into 3, 60, that is favorable. So the labor efficiency variance is favorable 60. It will be seen that the work has been finished with 150 hours compared with 160 hours. So the standard time set for the production is like this. So this could be attributed to the efficiency of the workers when low time is being consumed for production. So that is why the variance is lower as the labor efficiency variance. The sum of labor rate variance and labor efficiency variance is equal to total labor cost variance. It is 60 favorable, and that was 30 favorable, and it was it was 60 favorable and 150 adverse. 150 adverse means here in the labor rate variance was 150 adverse, and the labor efficiency variance was 60 favorable. So the net result is 90 adverse, and the direct labor cost variance was calculated, which was calculated earlier. It was 90 adverse. So the direct labor cost variance, since it is the composition of the two, direct labor rate variance and the labor efficiency variance, obviously the resultant of the two would be equal to the direct labor cost variance, and it is proved to be true here. So the causes of labor efficiency variance are as follows. The first one is defective or bad materials. When the materials, the quantity, the quality of the materials are not good, either they are defective or they are of low quality, then it will definitely result into labor efficiency variance. The second one is breakdown of plant and machinery. When there is frequent breakdown of plant and machinery, this may result into idle labor, and this will cause the labor efficiency variance. The third reason is failure of power. When there is failure of power, obviously the plant will be shut down, and there the laborers will spend their idle time, and this will definitely result into labor efficiency variance. The next one is efficient working of the laborers and fuller utilization of time due to incentive scheme. When the management, in order to ensure the efficiency of the workers, it increases the incentive to the workers and to the laborers. It may cause higher production with lower time, and this may result into labor efficiency variance. The next reason is loss of time due to delayed instructions from management or delay in receipt of raw materials. When the instructions from the management comes late, or there is any dilemma on account of that, if there is any interruption of production, or if the raw materials are not received in time, and that is also causing the interruption in production, that will also result into labor efficiency variance, because it will lead to idle labors in the hands of the laborers. The next reason is alteration in the method of production. When there is change of production from one product to the other, then there may be a time lag between one production and the other, and on account of that, there may be loss of labor and wastage of labor due to idle time, and this will also result into the labor efficiency variance. The next one is more time taken by workers due to lack of proper supervision and control by the management, making the workers lazy and inefficient. So this is clear. When the supervision and the control of the management is not sharp, then there will be lack of performance from the side of the laborers, and this would definitely result into labor efficiency variance. Then poor working condition. Poor working condition means if the working condition is not healthy, it's not congenial, it is not perfectly suiting to the laborers, then the efficiency of the laborers will definitely be affected, and it will result into labor efficiency variance. Next one is lower productivity due to lack of training, ability or experience on the part of the workers. If the workers are new, they do not have sufficient experience, they do not have sufficient training to execute the work, then what will happen? Definitely their performance would be poor, and when the performance of the laborers are poor, that will definitely result into labor efficiency variance. The last reason of labor efficiency variance is labor turnover or changeover of workers from one operation or process department to another. When there is change of laborers, that means if there is frequent labor turnover, the laborers are quitting the organization and new laborers are coming, or there is change of one set of laborers from the one department from one operational activity to the other, that will also result into the idle time, and on account of that, there will be a variation in the labor efficiency. So these are the reasons for labor efficiency variance. Then computation of labor variances. From the following details, calculate the labor variances. We can skip over this because it is already discussed. Then overhead variance. Next component is, after the direct material is over, the direct labor is over, the next one is overhead variance. Overhead means indirect expenses. The term overhead includes indirect materials, indirect labor, and indirect expenses. The term overhead includes indirect material, indirect labor. There are three components of indirect expense or overheads. That is indirect material, indirect labor, and indirect expenses. Overheads may relate to factory, office, or selling and distribution departments. However, for the purpose of variance analysis, we can broadly divide the overhead cost variance into two categories, that is shown below. One is variable overhead cost variance and fixed overhead cost variance, VOCV and FOCV. Each of these variances are discussed below. Overhead cost variance or OCV, it is the difference between the standard overheads for actual output, that is recovered overheads, and the actual overheads. The difference between the two would be regarded as the overhead cost variance. It is the total of both fixed and variable overhead variances. Overhead cost variance is equal to recovered overheads minus actual overheads. Variable overhead cost variance VOCV, it is the difference between the standard variable overheads for actual output or recovered variable overheads and the actual variable overheads. That means when the second one is deducted from the first one, that would give rise to the variable overhead cost variance VOCV. Thus, VOCV is equal to recovered variable overheads minus actual variable overheads. So when the actual variable overheads is deducted from the recovered variable overheads, it would be the variable overhead cost variance. The causes of this variable overhead cost variance, it may be due to the advance payment of expenses or outstanding expenses, or payment of past outstanding expenses during the particular period, or an account of certain normal expenses incurred, such as repairs of machinery due to breakdown, expenses due to spoilage, or defective workmanship, or excessive overtime works. For any reason, any of the reason as mentioned here, if the cost is going up in a particular period for which the variance is being computed, it will definitely result into the variable overhead cost variance. So fixed overhead cost variance is FOCV is equal to, it is the difference between standard fixed overheads for actual output or recovered overheads and the actual fixed overheads. That means when the actual fixed overheads is deducted from the recovered fixed overheads, it will give rise to the fixed overhead cost variance, that is FOCV. And causes of FOCV is difference between the actual and the recovered fixed overheads. It may be on account of a higher or lower amount of fixed overheads compared to the budgeted and fixed overheads might have been incurred for the same production during the same period. The same amount of fixed overheads might have been incurred for a high or lower production than the budgeted production during the same period. These are the two main reasons or causes of variances. Let us look to the illustration. The budgeted output is 10,000 units. Budgeted overheads is rupees 10,000. Fixed is 6,000 and variable is 4,000. Out of 10,000 of budgeted overheads, 6,000 is fixed and 4,000 is variable. And actual overheads is 12,000. Fixed overhead is 6,000 and variable overhead is 6,000. Both are 6,000 in case of actual overheads. And actual output is 8,000 units. Now let us calculate the various overhead variances. It will be appropriate to make the following basic calculations before computing the various overhead variances. The standard oblique budgeted overheads rate per unit. The computing the various overhead variances. The budgeted overheads divided by the budgeted output. Here the budgeted overheads is 10,000 units and the budgeted unit is 10,000 units. So the budgeted overhead per unit would be obviously ₹1. And the standard or budgeted fixed overhead rate per unit would be budgeted fixed overheads divided by budgeted output. That means ₹6,000 divided by 10,000 units. It is coming 60 paisa per unit. So the standard or budgeted variables is equal to budgeted variables divided by budgeted output. the standard or budgeted variable overhead rate per unit is equal to budgeted variable overhead divided by budgeted output. That means 4,000 is divided by 10,000 units. It is coming 40 paisa per unit. In this juncture, we will go for calculation of the overhead cost variance. The overhead cost variance, the formula is recovered overheads minus actual overheads. So 1 into 8,000 minus 12,000. It is coming 4,000 adverse. And the variable overhead cost variance, which is to be computed by deducting the actual variable overheads from the recovered variable overheads, it is coming 8,000 into 40 paisa, that is 3,200, when the actual variable overheads is 6,000, so it gives rise to 2,800 adverse. Overhead cost was 4,000 adverse, and variable overhead cost variance is 2,800 adverse. And the fixed overhead cost variance is the recovered fixed overheads minus actual fixed overheads. The recovered fixed overheads is 8,000 into rupees 60 paisa. So that is coming 4,800 rupees. And when that is deducted from 600, it is 1,200 adverse. So the fixed overhead cost variance is 1,200 adverse, and variable overhead cost variance is 2,800 adverse. When both are mixed together, it gives rise to the overhead cost variance that is coming 4,000 adverse. It is 1,200 and that was 2,800. Combinedly, it is resulting into the overhead cost variance, and the overhead cost variance is 4,000. Then fixed overhead variance may be classified as shown in the following chart. Fixed overhead cost variance may be of two types: fixed overhead expenditure variance and fixed overhead volume variance. Fixed overhead expenditure variance and fixed overhead volume variance. Fixed overhead expenditure or budget or controllable variance. It is the variance is due to the difference between the budgeted fixed overheads and the actual fixed overheads and the actual fixed overheads incurred. So fixed overhead expenditure variance is equal to budgeted fixed overheads minus actual fixed overheads. That means when actual fixed overheads is deducted from the budgeted fixed overheads, it is the fixed overhead volume variance. Fixed overhead expenditure variance, right? Accordingly, when we go for calculation of the fixed overhead volume variance FOVV, the variance arises because of the difference between standard and the actual output, resulting in under or over recovery of fixed overheads. It is therefore the difference between the variance. It is therefore the difference between the overheads observed on actual output, that means the recovered overheads, and those of the budgeted output or the budgeted overheads. Thus, the FOVV, that means the fixed overhead volume variance, is equal to recovered fixed overheads minus the budgeted fixed overheads. Let us take the example from the illustration 11.5. Calculate the fixed overhead expenditure variance and the fixed overhead volume variance based on the data given on this earlier illustration, that is 11.3. The budgeted fixed overheads, the budgeted fixed overheads minus the actual fixed overheads, that is the 6,000 minus 6,000, that would be 0. And the fixed overhead volume variance is the recovered fixed overhead variance minus the budgeted fixed overhead variance, budgeted fixed overheads, that is 4,800 minus 6,000, it is adverse 1,200. When you go for verification of the fixed overhead cost variance, that is the fixed overhead expenditure variance, that is plus the fixed overhead variable variance, that is 1,200 negative, and that is or adverse, and that is 0. So it is 1,200 adverse. So this is about the overhead variances. Then next one is the sales variance. Sales are affected by two factors, that is the selling price and the quantum of sales. The variation in the standards set and the actual for the purpose may be mainly due to the changes in the market trends, because the market trend is the major factor in determining the variation in the sales. Usually, if the selling price increases, the volume of sales will be lower than the standard. It is due to the demand and supply factor. It may result in a favorable variance as to the price of unfavorable variance as to quantity. It is to be borne in the mind that higher price here is to be viewed as a favorable or higher price paid for the material to record cause an adverse variance, and the lower volume of sales is to be viewed as unfavorable. In case of materials, it is the other way around. The lower uses of materials than the standard causes by the favorable variance. It is well known that the demand and supply position of the market decide the quantity of sales and the selling price, because it is the law of demand. Law of demand says ceteris paribus, that means other things remaining constant, higher the demand, lower the price, and the vice versa. So that is the major factor which determines the sales variance here. The variations in the sales may be on account of control law as well as non-controllable factors and non-controllable factors. Changes in market conditions and demand by customers are of course beyond the control of the management. However, there are certain factors like high price are controllable by the management, which is within the hands of the management, and an effort should be made to check adverse variations due to these factors. Sales variance can be understood with the help of the following chart. It is of two types. One is sales price variance, another is sales quantity variance. The difference between the budgeted sales and the actual sales is the sales value. One is the sales price variance and the sales value variance. Here there is a printing mistake. So the formula for sales value variance is the budgeted sales minus the actual sales. And when the actual sales is more than the budgeted sales, the figure is favorable. And in case the opposite, the figure is unfavorable or adverse. The difference in the value on account of difference in price or volume in sales, which is therefore analyzed in the sales variance. Sales actual quantity sold, if it is multiplied by the standard price minus actual price, it will be the sales price variance. That means sales price variance is equal to standard sales minus actual sales. And sales volume variance can be calculated by the standard price where it is multiplied by the budgeted quantity minus the actual quantity. That means sales volume variance is the resultant of the budgeted sales minus the standard sales. So this is all about the standard costing or the variance analysis, which is otherwise known as the analysis of variance in detail. Thank you.